Hi guys, and thanks for tuning in to the Nuggets podcast. So we'll probably put this up on YouTube as well. But welcome, Pomp, and we're going to talk about security tokens today. How you going?
I'm doing well. Thanks for having me.
Well, mate, we've both been in here a few years now, and the landscape's changed from 2015 when it was pretty much Bitcoin and maybe Litecoin and a few others. Last year it all heated up. In 2016, ICOs were around though, and you could send in some Ethereum and get your hands on some DGX just from the ETH address on the website. That all changed a fair bit last year. So, how did you see it all changing last year?
Yeah, look, I think that there's kind of two separate camps, right? So there's all the utility tokens and liquid active trading. People really looking for financial upside. And then there's what we consider to be the more sustainable infrastructure protocols and kind of technology that's being built. And so, there's a Howard Marks quote that I really like that says, in order to be in the top 5% of annual returns, when you're wrong, you end up in the bottom 5% because you take so much risk, right? And I think we really saw that play out last year through 17 and into 18, where people were taking a ton of risks. They were speculating on assets. There was this huge explosion. Some people were in the top 5% of returns, and then all of a sudden the rug got pulled out from underneath them. Prices crashed, and my estimation is that more people have lost money on Bitcoin in the last 12 months than have made money. And so I think that the focus is shifting back to the technology and the protocols and kind of the infrastructure that needs to get laid for this industry to actually be sustainable for the next decades to come.
Exactly. I think some of those best projects, DGX, Zero X, they were working on this for years, and then everyone just thought that every ICO was a way to make money and huge returns. So the space heated up last year. Things like seed rounds, private rounds, first, second, third rounds of public sales, that was all unheard of. People spending thousands of dollars on gas and all that sort of thing. So it definitely got, overvalued, and now it's kind of died off and trended down throughout this year. I think if you look at the numbers, mate, I'm not sure what you've read, but I think if you take out EOS and Telegram, it really has been a significant downturn, even though some people like to say that ICOs are still raising plenty of money. So where do you think we're at right now?
Yeah, look, I think that there's an acceleration of capital flowing into the market in the private side, right? So on the public side through the ICOs, I think that you just see a drawdown in kind of total volume, mainly because the U.S. regulatory environment has become super uncertain, and it's forced people to kind of go offshore. So that just makes it more difficult. But in the private markets, I think actually there's been an inflection point. You're seeing more and more capital flow in. Definity raised 100 million plus, and there's a bunch of other projects that are kind of continuing to raise this capital. The difference is that it's coming from kind of accredited investors or qualified purchasers at the fund level. It's not coming from kind of the crowd or the non-accredited folks. And so, there's pros and cons to that, but I think that's actually what's happening.
Yeah, that's probably a good segue into the next question about security token world. Do you see that being just for the accredited investor, and do you see them continuing to go to VCs to raise those amounts, or is there going to be any way for the average guy, the mum and dad investor, to be involved in this space?
Yeah, look, I think we've made our opinion very well known that the most ridiculous laws we think on the security side is around accreditation, right? And so today in the United States, it's based on wealth, right? It's literally the rich get richer written into law. And so if you don't have either certain levels of income or certain levels of net worth, you're precluded from being able to invest in, what are some of the best performing investment opportunities. They're also the riskiest, right? And so the argument is that, using wealth as a signal for either intelligence or as a signal for the ability to withstand losses is kind of how the law is written. Now, we actually think that it'd be a much better system if we were able to change the accreditation laws and base them on knowledge, right? So if you were able to take a test and prove that you have a certain level of education around investing, around risk management, around, kind of underwriting these deals, we think that's a much better system. Two, it's actually a safer system. And then three is it would allow for the greatest amount of individuals to participate. So I always go back to this idea of, and this is obviously specific to the U.S., but the American dream, right? So, the promise of the American dream is that anyone around the world can come to the United States and can create wealth for themselves in our capitalistic society. But what we've done is we've taken away a majority of the greatest investment opportunities through these accreditation laws. And so really the law is in direct contrast with the American dream, right? Now, what does that mean for security tokens? We think that today, obviously, these security tokens are going to continue to use the existing laws or frameworks that are available. So this is Reg D filings, Reg S filings, et cetera. And those are usually only open to accredited investors. The SEC, Chairman Jay Clayton has came forward and said, look, he's thinking about, ways that he can actually open up some of these private market opportunities to non-accredited investors while still providing investor protections, right? And so I think that you see, the most important regulatory body in this space thinking about this. I think with the ICO boom, you saw that there's definitely pent-up demand or interest. And so my guess is that over some period of time, 2, 5, maybe even 7 years, we're going to see some changes in those laws that will allow the private non-accredited investor, or that retail investor, to start to participate here. But what that looks like, I don't think yet we know. And so, I don't envy the people who have to figure that out.
Yeah, I think we have slightly different laws in Australia as well, in terms of being able to participate in those IPOs, which I clearly remember doing personally, mate. There was a Bitcoin miner and they didn't get listed, and that would have done between 100 and 1,000x by now, I reckon, if that had got listed in 2015. Anyway, how do you see that side of things in terms of where they're going to be listed and traded? So, Polymath and T0, Swarm, Banchorus is one that we've done a bit of work on. Where do you think that all sort of fits into this picture? We see some of these exchanges moving to Malta and the Cayman Islands. Is it a shame that everyone's moving away from the US and Australia because of, I guess, the regulatory hurdles? And do you think that once these tokens are freely tradable, if Ethereum's going to allow them to be traded by the average investor?
Yeah, so one, I think that what we're going to see built out in this tokenized securities world is very similar to what we have in the traditional market. So every stock, bond, currency, and commodity will be digitized or tokenized, right? We've already started to see this in terms of, look at the currency. So U.S. dollar, 92% of it is not in paper notes, right? And so there's been some electronic or digitization of the US dollar. I think you started to see this in equities with things like AngelList and Carta/eShares, where you start to receive the stock certificate or the cap table in electronic or digital form. And so we think that this is just going to permeate across asset classes. Now, what does that mean for where can you purchase them? Where can you hold them? Custody, transact, et cetera. Well, again, we think it's going to look very similar to the traditional market. So if you look at, let's say, public equities, for example, you've got the New York Stock Exchange, NASDAQ, TSX, London, Singapore, et cetera. And what ends up happening is each one of those exchanges finds its own niche. So some are kind of the global leader, some are for high growth, high speculation companies, some are for smaller, high growth companies, and so the same thing is happening in the tokenized securities world. So you've got Open Finance, T0, right, on the exchange side, Templum. Then if you go to the issuance side, you've got things like Securitize, Harbor, Polymath, Republic, Swarm. You just go through the whole thing, right? And so as you start to see a lot of these infrastructure plays around issuance, exchanges, protocols become more mature, I think what's going to happen is there's going to be a war of attrition, right? And so some of them are going to have a first mover advantage. Some of them are going to be better capitalized. Some of them are going to kind of split off and find a niche and be the global leader in real estate or whatever it is. But as that occurs, I think that you're going to have to see some marketplace matching is what we call it, right? So the supply and the demand. There's going to be plenty of deals that are coming online out of these tokenized securities. They're going to have to go find a home, right? And so those service providers or platforms are going to have to do a great job marketing themselves or kind of putting a flag in the ground of what they're good at and what they're looking for. And so that will allow some efficiency to take over in the market that just isn't there today.
So are you keen on any projects in particular? Are you looking for the individual projects? We saw Great Keppel Island in Australia get talking about going. Are you looking to invest in those per se? Or are you more those infrastructure plays where the money's going to be flowing through that you want to capture a bit of that?
Yeah, so right now we're just investing in the infrastructure side. So really looking at kind of the total ecosystem. And the way that we think about the infrastructure side is I want to invest in things that will benefit from the overall growth of the industry, right? Without taking the individual risk of a single liquid asset, right? So this is things like wallets, exchanges, mining facilities, data providers, etc. And I think over time, though, we will absolutely go into the individual projects of the tokenized securities. Part of that is we've got to see really high quality deals, right? So one of the things on the tokenized security side that I think people forget is tokenization or digitization of an asset doesn't make a bad asset good. Tokenization or digitization of an asset simply makes a good deal better or a bad deal worse. And so all you're doing is you're highlighting the quality of the deal on a global scale. And so I think what we've seen kind of initially is a lot of deals rush into the ecosystem that are, probably not the highest quality. And so as that continues to improve, I think what you're going to see is more and more sophisticated investors, kind of legacy investors, get excited about how to participate here. But they're not going to do a tokenization deal just because it's tokenized. They're only going to do the deal if it's a high quality deal.
Yeah. I guess for the guys at home that are maybe beginner investors as well, I guess it's the equivalent of if a new metal, lithium falls into favor, you're not going to go out there and try and find the lowest lithium penny stock. You're maybe going to invest in the lithium ETF or, someone that provides all the miners that utility. And then once you've done more research and we've had time to see how this all plays out and the legislation changes, then you can go into the specific ones. And do you think that's a problem that people see in crypto in general? They're trying to find the next 100x when the best projects are probably the safer ones, I guess, that have still got plenty of growth ahead of them are often the larger cap coins?
Yeah, I think there's two pieces, right? So one is kind of the quote unquote best deals are still being fundraised privately, right? So by the time a lot of these deals are public, right, through public sales, et cetera, there's investors who have poured in millions of dollars in heavily discounted rounds or kind of pre-ICO rounds. Yeah. And so just by the nature of not being well connected in an industry, public investors are not getting the best deals, yeah. Right? So that's kind of step one of the issue. And then two is, most of the individuals that are raising non-dilutive capital through ICOs are also creating a situation where there's misalignment between the founding team and those investors, right? Because their individual incentives are driven by different things. And so what we've really spent a lot of time thinking about is when we make investments, especially in non-liquid equity, we always talk about how much incentive alignment is there between the founding team and us, right? We want to make sure that there's full alignment. And so I think that what we're starting to realize across the market is that a lot of these ICOs have a misalignment in those incentives. And so, hopefully teams can figure out ways to kind of reel that in so that there's kind of higher levels of incentive. Because one, I think it makes these projects more sustainable, and it makes the overall industry more sustainable. And then two is if you burn investors up front, there's a lower likelihood that they will come back. And so you've got to really spend the time to make sure that you've got a project and you've got a fundraising mechanism that allows other people to benefit from your success in the same way that you do.
Yeah, exactly. So I've got a question from one of our subscribers here, Pomp, and that is, do you see this going on public open source blockchains like Ethereum, or do you think this is going to all end up, behind closed doors, private blockchains? Is everyone going to have to be KYC'd, and then it takes out a lot of the benefits of blockchain if it's not transparent and so on?
Yeah, so I think that you've got to separate those two things, right? Kind of public blockchain and the KYC AML issue, right? So I think it is very, very hard to see a world where there's not KYC and AML conducted. Mainly, this is driven by governmental regulations that are trying to prevent, nefarious activity, money laundering, etc. And so I think that just like we see that in the traditional banking world outside of securities, right? Just to get a bank account, for example, I think that we're going to continue to see that, and there's a lot of benefits to that type of structure. I think that if you move to, what protocol does this get built on? I do have a high level of confidence that this is going to be built on a public blockchain in a very transparent way, kind of open source financial system. And what I think you're going to find is there's going to be various levels of permissioning that goes on in terms of the transparency of the information, right? And so one of the things that is playing out in the traditional markets right now that I think highlights this is here in the U.S. there's conversation about moving from a quarterly public company reporting structure to a biannual, right? So kind of twice a year. There's a argument to be made that actually we're going to, instead of go to less reports per year, we actually may go to a more real-time streaming type structure where people are actually able to see, the revenue and the usage and kind of expenses, et cetera, via blockchain or some sort of, transparent data sharing. Right. Yeah. I don't know where we end up there, but I think that's the type of stuff that an open financial system really allows us to do, is have that greater access to information that's driven from the desire of the investors and the participants in the market saying, you can no longer hold this information from us and use it to your advantage and at our detriment.
Yeah, I mean, Wall Street would miss their quarterly games and insider trading, I think, mate, unless you want to do it 12 times a year, maybe. Yeah, that raises some interesting questions, though. If you can raise money and you're accredited, and then if it's on the Ethereum blockchain, well, how, send that token to a decentralized exchange, and then if they're not KYC'd, if you can do that anonymously in the future. It's so interesting to watch this play out. We did a video last week about the biggest issue that people aren't talking about that I see is Bitcoin and Ethereum talking about going private in the next 24 months. What's that going to do? What's it going to do if there's an ETF at that stage? So plenty to think about. Do you have any thoughts on that just quickly?
Yeah, I tend to think that the whole going private thing would be relatively difficult to execute. When it comes to the ETF, et cetera, right? I think I spent a bunch of time talking to kind of Wall Street veterans. Caitlin Long had a great podcast that I did with her around what happens if Wall Street runs in and gets these retail products approved, right? And I think that there's kind of two components here, right? One is there's greater access to the asset class for a large number of people, right, who aren't going to go sign up for a Coinbase account. They want to kind of buy the asset in their brokerage account. Yeah. But the flip side of that is, the rehypothecation of Twitter could be detrimental, right? Basically Wall Street creating artificial supply of an asset, kind of attacks the core proposition of Bitcoin, for example, right? On its, set cap and its deflationary element. And so, I think that there's pros and cons to both sides. I tend to think that, my overarching sentiment is just we'll be okay, right? We've survived this long and kind of seen, things that were heavily fear-mongered, and then we've seen things that were, kind of overhyped. But as we go through these cycles, I tend to think that a long time horizon, we'll be okay.
The honey badger, it's anti-fragile, mate. It just keeps getting stronger and stronger.
Absolutely.
One more question I had was about your recent change in your prediction. So, you and I guess we've both been uber bullish since the start, and people say, how can you remain bullish in 70% corrections? But it's part of the norm if you've been here for a few years. You pushed that 50K prediction back to 2023. Now, I actually think we're going to get there quicker than that, so I'll play devil's advocate. But what made you push that back?
Yeah, I think twofold, right? So this all was spurred by a conversation I had with Ethan Ackerman, right? So I think he's at Crypto Ethan or something on Twitter. But he came and saw me, and we were having a conversation around a whole bunch of these kind of data-driven indicators and kind of the market analysis, and he kept pushing me on this idea that you've got to look at the data, right? And so as we talked kind of more and more about it, I think that, what I really realized was kind of twofold. So one, on the data side, right, it doesn't look as bullish as I think people want it to look. That's okay, right? Just kind of takes longer to get there. But I think that the second component of this is the psychology, right? And so, one of the things as I spent more time thinking about kind of behavioral economics and the psychology of investing is not enough people have forgotten the hype and pain of what just occurred over the last 12 months, right? And so if you kind of think about the sentiment on Twitter, there's tons of people who think that the market's going to recover very quickly, right? And so I forget who says the quote, but basically, the idea of like, you don't buy until there's blood in the streets. Yeah. right? And I don't think that there's any blood in the street, right? And so I think that we're going to have to experience a lot more pain before kind of these, long-term holders and these individuals who are, just deep believers really start to feel that pressure and start to question things. And at that point, I think, kind of around that $3,000-$4,000 mark, I think for Bitcoin, I think that's really where we start to see kind of the bottoming out and some recovery. Now, I caveat all of that and say, I've been wrong before, right? Predicting the price of Bitcoin or any of these assets is somewhat of a fool's game, right? We play because it's frankly entertaining, and we tend to think that it keeps us interested, right? And kind of have some skin in the game on predictions, etc. But at the same time, no one should be making investment decisions based on what we think today because it may change in the future, etc. And so remembering why we talk about the price, I think is just as important as what are we actually saying when we talk about the price.
Yeah. I think there's just so few percentage of the world. I think we often focus on Australia or the US. I think it would only take the slightest bit of adoption in Africa or a European country to really drive that Bitcoin price up because of how scarce it is. So I just don't see us going into like a 2-year winter like 14 and 15. There's too much happening. The word's spreading too quick. I think there's so many issues in the financial world for emerging markets and so on, currencies. So I think Bitcoin's going to have its day, but who knows? Any final thoughts you want to share with us, mate? I really do appreciate you coming on, and we'll keep in touch because we love security tokens. We definitely think that's the future as well, and we love what you do with your digital asset fund. Absolutely. No, look, I appreciate you having me. You're obviously spending a bunch of time and kind of pushing the narrative and really kind of familiarizing people with the asset class. And so from us here at Morgan Creek, we really appreciate all the work that you're doing, and let us know if we can do anything to help. Legend. Thanks for joining us today, Pomp. Cheers, guys. Sounds good.